Don't place a trade based on what you're seeing in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. So traders, I want to just do a market update for you guys. I'm going to go through the indices, and I'm also going to go through silver and gold and some of the metals there as well too. And also what I'm going to be covering in this video, guys, is the one thing that you could, and it really is the one thing that you can do today in your trading to help you become to help you to remove that fear, right? Because one of the biggest things that stops us in the markets, right, is fear. Fearful of having a losing trade, fearful of fearful of it not being right. There's a lot of fear there, right? There's a lot of fear that actually happens that goes along with your trading, right? So what if this is a stop out? What if I get it wrong? And all this sort of stuff. So I'm going to teach you the one thing that can really help you long term in these markets to think differently. And also this one thing is also going to put you in a position where you can risk small on your account, but have the potential to do really well long term on your account. Okay, so guys, if you haven't done so yet, then make sure you click on this link in the descriptions to grab the trading course for $7, or if you just want to get access to the Master Trader Lab free trial, which I'm taking down real soon. So if you want to get access to that free trial to the Master Trader Lab, then all the links are in the description there below. Now, let's get straight into the market update here, because there is something that I'm really noticing here that's actually really, really interesting. And that is that by looking at the Dow Jones here, okay, by looking at the Dow Jones, we can see that we've had this market that's had a nice rise through here, and we have a bit of a pullback through here, okay? So if we bring up, say, the last, 3 months here, okay? So we had a nice rise up, and now we're having a small little pullback through here. This is probably a bit of a short-term resting phase before we blast off to all-time new high. So that all-time new high level is up there. So I wouldn't be too surprised. Let me just delete it off the screen. I wouldn't be too surprised to see just a little bit more of a resting phase, and then possibly a break and a run back to the upside. So that's what I'm noticing through there on the Dow Jones. If we do break that, then I actually have an ultimate target on the Dow Jones around 29,000. So if we break this level here, which we're probably likely to do, then we're likely to go for another run in the markets there. Same with the S&P 500. We can see we actually had a pullback, a run right up, and you see how it came all the way back down. And where did it bounce? Once, twice, 3, 4, 5, 6 times at that 60% Fibonacci level. And then also around the 50% Fibonacci level as well too. And you can see how it bounced there, and then continued up, right? And now we're at this level here. So no doubt there's going to be plenty of stops up here, but no doubt I do believe this time that when it does break, we're probably likely to continue running from there. And even the Nasdaq as well too. Nasdaq is the same thing as well too, where you had the market came down, found support, rallying back up. So I wouldn't be too surprised if we did go for another run there. But again, guys, there's no guarantees of that happening. So be smart about the way that you're doing things, right? Because this thing can turn on a dime really quickly. One thing that I am noticing, if I bring up, say, 1 year worth of charts, is look at the low volume that's been happening here on this rise, right? We haven't had a lot of big volume spikes, have we? And so if we start to get a downward phase, if we start to get a downward movement with volume, that's probably likely to see a bit of a sharp sell-off here. So just keep an eye on for that as well too. Now, guys, one thing that's really important to understand is okay, when you're doing analysis, well, I'm doing my analysis right now on the S&P, the Dow Jones, on the indices, okay? But this is so important to say, I am doing my analysis on these indices here. This has nothing to do with the individual stocks of the stock market, because they're all in different phases. Some are already in bear markets, some are just going sideways, some have been going through the roof right now, like Microsoft and other companies. Do you know what I'm saying? So if you say the stock market's going to crash or the stock market's going to go down, that's a big blatant statement to say that. Makes sense? Because there's a lot of stocks already been in a bear market for quite some time right now. Just look at GE, right? It's like, so it's really important that when you're doing your analysis, if you do your analysis on the Dow Jones, then please, and the Dow Jones looks bullish, then don't bring that biased view to any of the stocks, because it's so important that just because the Dow Jones goes up or the S&P goes up and we have a really good update doesn't mean all the stocks are going to have a good update. In fact, I guarantee you 20% of the stocks are going to have a good down day because they're already in their cycles. They've been stair-stepping lower. They're in the different phases. They've been going down or sideways or whatever. Make sense? So it's not, and it's so important because we look at the S&P as like what all the stocks are doing, right? We think about as the S&P 500, we think about all the stocks are doing this. The S&P 500, the Dow Jones, well, look at S&P 500. The S&P 500 went down. The stock market went down today. Yet I guarantee you, even if we did have a big down day, guess what? Most of the stocks are doing, right? Most of the stocks have been, some of the stocks, should I say, some of the stocks, a good percentage of the stocks, so guess what, are likely to continue up and running from there, right? I've been in a big bull market. So from that process, guys, please, when you're doing your analysis on that, just make sure that you keep that in mind, okay? The most important thing to do when you're trading, or one of the most important things to do as you're trading, is you take a trade based on that individual market you were trading. So if you're looking to place a trade on the SPY, you do it because of what the SPY's doing, right? The pattern and so on and so forth. If you're looking to take a trade say, for example, all right, if you're looking to trade, if you're looking to trade, put a trade on, say, Facebook or Apple, right, which is a tech stock. Well, you don't trade Facebook based on what Nasdaq is doing. If Nasdaq's likely to rise, or you think it's going to rise, then don't go place a trade based on Facebook or Nasdaq, right? What you want to do is you want to go to Facebook. Let's just bring up Facebook here, right? And then what you want to do is, what do you want to do? You want to actually then go and place a trade based on Facebook, based on what Facebook is doing. Make sense? So it doesn't matter what it is. It's Amazon, Facebook, Netflix, whatever. You only want to trade based on what that company is doing. Moving on now to silver and gold. And the gold market through here is still at a level where it's just sort of just going sideways. Notice how we actually had a run up, pretty much sideways for the last 1 to 2 months. And this is to be expected. You know what I mean? Like if you see through here, right? Like when the market ran up, that's what I was saying, is that the market is likely to have a good pullback, or we're likely to go sideways for a month or two because we have already had a big move up. So sideways for a while, and then it's probably likely to get ready to go for another run there. Either way, guys, I do see a good bull market in there. But as you can see, right, we're getting a bit of a sideways phase through here right now. So this could be a bit of a sideways phase. If we do get a bit of a drop out of this here, then it's probably likely to be short-lived. What I mean by short-lived is even if we do get a bit of a drop out of gold and a bit of a pullback, it's probably likely to get back down to the 1400, and a lot of buyers are likely to kick back in there. Same for silver, right? Look what's happening with silver here. The silver has actually had a lot of support through here. And then now what's happened, we broke down. And then now we're just sort of hovering around here right now, right? So I wouldn't be too surprised to see a bit more of not much happening with silver and gold for another few weeks as it rebuilds its energy, rebuild its fuel. And then it's probably likely to go for another good run, okay? So even if it has a bit more of a backing pattern, a bit more of a pullback even on silver there, but you can see the reason why silver is actually where it is right now. So I'm still long-term very bullish, but if you're looking to trade the markets, guys, just be patient and wait for that setup that you know that works for you, okay? Just be smart about that. Now, as you can see, guys, right, like this is the analysis that here and the analysis that I keep talking about here and so on and so forth. So, guys, one thing that's so important to, is make sure you understand, chart reading techniques, the trading system, so on and so forth, and all that sort of stuff. So guys, make sure you grab that, that brand new, or my trading course that I'm running for $7. There's a link in the description. Make sure you click on that and go get it, because I'm going to teach you different things like the foundations, chart reading strategies. I'm going to give you a couple of different trading systems to make sure you stay on top of everything. Now, I want to finish off with this video with the one thing that almost destroys the one thing that destroys every single trader on this planet, bar none. And if people understood this, that they can flip it on its head and look at it differently, and it can create such a positive ripple effect throughout your trading career and throughout your account. And that thing is this, okay? We all know about risk management, okay? Now, I'm bringing this up because I had one of my private clients. I did a coaching. I do a weekly coaching call, okay? So I do a weekly coaching call every single week with my private clients, right? It's a group coaching call every single week. They come in and I do a weekly group coaching call, and we went over all the indices. We even went over some of the crypto markets as well too. Some things I'm really excited about the crypto market, what stocks some of the stocks I'm looking at, and what I think long term, and just a whole bunch of. It went for almost 2 hours. It was amazing, absolutely amazing with my private clients. Now, if you're interested in becoming a private client, I've still got a few spots left open. So there should be a link in the description to a web class. Go check that out, and you'll be able to see all the details about that. But the thing is, this, guys, is that I had a private client of mine, and he said, John, I'm always afraid. I'm always fearful of having a stop out. I'm always fearful of having a loss. And I said to him that, one, losses are a part of the game, but why are you afraid of that? And I said to him this. I said to him, let me ask you a question. I said, if you had a $10,000 trading account and you knew your maximum risk on this trade was $200, would you be afraid of having a stop out? And he said, no. And that is where most traders go wrong. They think in the back of their mind that they think the more they trade, the more money they trade on their account, the more money they are going to make. And it's the exact opposite. What's likely to happen is, because you're trading so much of your account, you're so emotional, and you're going to make an emotional decision, get out at the wrong time, and all this sort of stuff. And that alone is going to cause you to, one, get out of a good trade when you shouldn't get out of the trade. And secondly, get into a trade based on because you're just trying to make a lot of money. And then it's a ripple downward effect on that. See, and from that, right, and from that, even if you do have a couple of losses, that could be detrimental to your account. Before you know it, your account's down 30-40% in just a couple of losses, and now you're kicking yourself, right, from that, which is just way too much. But if you flip it on its head, say, okay, you know what, I'm going into this position and I may be wrong. This trade here may be a losing trade. I must accept that up front. So if this is a losing trade, if I'm wrong, so to speak, right? If this is a losing trade, what am I risking here? And am I comfortable with that risk? And if the answer is no, then you're putting too much risk on your account. If the answer is yes, then that's where it's at, right? And so now picture this, right? Picture two different types of traders here. Let's say they both have 10K trading accounts, right? This one 10K here. It's called its trader A, and let's try to call B. Okay, both have 10K trading account. Right, so look at this here. So this 10K trading account, he's loading up, right? So he's placing a 5K position size on a trade, and he over here right now, he's actually, he's only placing a $200 position here. Now think about this as long term, right? Most people think, well, John, how can $200 get me to a point of making a lot of money in the markets? See, but if you don't do this, you're going to blow yourself up out of the water. You're going to go absolutely just, right? That's whoosh, whooshka, which simply means you're gone, right? Right. So he places a $5,000 trade on the exact same trade, by the way, right? And let's just say we have a bullish trade here. Let's say, for the example, we had a nice little breakout bar, and we both here. Trader A traded this here, right? And trader B did. And let's say, for example, their maximum risk is down the bottom here, right? So $200, that's where their maximum risk was. So let's have a look at this here, right? So, and so they entered this trade. This guy, $200, is he emotional? No, right? So let's say the next day does this. Does nothing. What is the guy with the $5,000 trading account, which is down just slightly? Oh my goodness! Oh, I can't believe, mate. Say it's an options trade, right? You trade options. Oh my goodness, my position's down, 10% or 20%. Oh my goodness, I'm down, all this. I've just lost $1,000. Oh my goodness, I'm not sure. I don't know. All right, the $200 guy says, you know what? That's okay. If it comes down to here, I'm going to get out for a $200 loss. right? Now that's not true because it comes down to there, you probably get out for 50% of that, right? So 50% loss. But let's say, for example, he's maximum risk, absolute worst case scenario is he loses $200 here. But, remember, guys, he's just focused on protecting himself, right? So the $5,000 trader, let's say for the example, the next day does this, right? Market opens, rallies up, comes back down, and closes there, right? Is it at the low of the bar where you're going to get out? No, right? Now, this time the position's down on the $5,000 position. This time, the market's pretty much gone sideways, but now the position's down now maybe, say, 20%, maybe 30 or 40%, right? So now you're down about $1,000 to $2,000 on that 10,000. What is this guy thinking here? Right? He's now thinking, well, oh my goodness, I can't lose any money. Oh my goodness, I thought this was a good trade. I thought it was going to run off a profit. Oh my goodness, I can't handle this. And the $200 guy's like, you know what? That's okay. If it gets down to here, then you know what? I'm going to get out and I'm just going to take it on the chin. So what does this guy over here do? Because he's so scared of losing money, he comes over here, right? He takes his, he takes his 2K loss because he can't afford to lose any more money, and he takes a 2K loss, and then a week later it does that, and not only does it do that, but this guy over here generated 100% return on the trade, which gave him a nice 2% increase on his account. Do you see what they go there, right? And as the market continued up, now he's up 2%, where this guy is down 2%. It's the exact same trade, but different emotions go involved with it. Your number one rule, guys, when trading the markets is protection. Protection, because I guarantee you, every time you try to load up on a trade, every time you try to increase your position size, that is going to be a losing trade. Okay, because I've seen it so many times within my trading career, I've got the t-shirt for it because it's going to smack you, right? And every time I've got a good small risk on my account and I'm not emotional about that position, guess what? They're the trades that end up running on quite nicely. Make sense? So as you're going through your trading career, this one thing here is going to keep you in the game and keep you going more and more in the markets, right? And then you start to increase your position sizes to 400, so on and so forth. Now, the other thing that I do, guys, is I go up with my percentages and down with my percentages on my position sizes, okay, based on how I'm trading. Now, what I mean by that, let's say, for example, I start out by trading 2% of my account, okay? And then I have a profitable trade. Let's call it here a winning trade. And then I have another winning trade. And then I have another winning trade. So now because I'm trading well, I'm going to increase my position size from 2% to say 4%. Well, you know what? Let's just call it 5%. 5% of my entire account is I'm going to put into the market. Right with me so far? And so I'm going to that. And now I'm going to have a winner here. But what happens is this, right? So now as I'm profitable within my trades and I'm trading well, I'm increasing my positions, the percentage of my account on any given one trade. So therefore, it's a ripple effect. It's going to supercharge my results because I'm increasing my position sizes slowly as I'm going through a good winning streak. But if I start to go through a losing streak, let's say for example, I'm at that 5% and then I have a loss here, and then I have another loss here. Guess what I'm going to do with that 5%? I'm going to drop it down to 3%. If I have another loss, I'm going to drop that down to 2%. Makes sense? I'm going to drop it down really, really quickly until I can sort my shit out, whatever's happening, because I'm going through a bit of a bad period right now. Maybe I'm just picking shit trades. But this is how I protect my account. Right, so when I'm doing well, I increase it slightly, not too much. So I'll never go way too much, but I keep increasing it slightly. So as I'm trading well, it supercharges my results. But if I get up to here and I start to trade really badly, I drop a percentages so I don't get this pullback here. Right, so when that happens, I will get a nice curve that looks like this as I'm trading well, and then when I go through a bad period, I might just get a pullback like that. Sort my shit out and then continue up from there. See what I'm saying there? So it creates that equity curve there. If you start to apply this to your trading, guys, you're going to have a very long career, because the capital preservation, capital preservation is number one in the markets. Okay, it is absolutely number one in the markets. And if you want to be part of this game for a long time, instead of being what most of you guys are going to do, which is not do this. I understand. I've been there. Then you're probably going to blow yourself out of the water because you're trying to make too much money really, really quickly, and that's not the name of the game. And I hope you can see that if you're trading too much and it's going to cause an emotional imbalance inside of you, you're going to, even if you do get into even if you do get into good trades, it's going to cause you to make an emotional decision, which will cause you to create the very thing that you're fearful of, which is losing money just by getting out right at the wrong time. And then watch this thing run on. I've seen it so many times with my private clients. We would get into a trade, call it a bearish trade, right? We would get into a nice, let's call it a nice little breakdown bar, right? Nice little breakdown bar from here. What the hell is that? So a nice little breakdown bar from there. We'll get into a nice little breakdown bar, and I would stay in, and it would do this the next day. It would do this the next day. And so this day here, right? So what are some of my private clients doing? They're freaking out big time. Then they get out, and it does this the next day. Then it does this the next day, this the next day, and this the next day. And down here, guess what's happening with some of my private clients? They are fuming. Now, was it the market that got them, or them that got them? Them that got them, right? That's them that got them. Them that got them, right? So as you can see, right, it's that if you're trading way too much, you're going to make an emotional decision. You need to do whatever you can to lower that emotion as much as possible. And from that, you can start to increase your position sizes. And do you know this trade here eventually ran onto a 300% return? Now, put that in perspective, right? Put that in perspective. This trade I'm talking about here, some of the traders got out with about a 20 or say a 30% loss. And even if you did have a 10K trading account, right, a 10K trading account, and they were trading, say, call it a 30% loss, call it they were saying trading, say, $1,000 on the trade, and they were freaking out, so they made 30% loss. They actually lost $300 on that trade plus commissions. All right. But then the guy who was only trading, say, $200, let's say he was only trading $200, which is 2% of the entire account. That's the worst case scenario. Guess what? What did he make out of that? He made what? $600 because he was no longer doing that. And do you know that's a 6% increase on your account? Now, you guys might think, oh, well, John, it's not a lot of money. It's $600. Well, guess what? It's only a small trading account. What do you expect? And then guess what? Then the next trade comes, and before you know it, you made, another one there, and you may say $400 here on this next trade. And before you know it, your account is now up $1,000. You just made 10% return on your account. Stop thinking that you're going to make 50% return on your account in one trade on these big positions, because it's going to smack you every time in that there. Now, guys, I'm just giving you the laws of what it takes to get ahead in the markets, and we all know that we need to remove the emotion as much as possible. How do we do that? Create small risk on your account every single time. So if it is a losing trade, you protect yourself, and if it is a winning trade, you can start to create the effect of 2, 3, 4, 5 times the amount of profit compared to the risk. If you start to create that situation, yes, you're going to have you're going to have your losing trades, but you don't care, because you could have 2 or 3 losing trades in a row and just one good profitable trade, and you're still making money. That's the name of the game with your trading.